into trading that there's an element of gambling to it. It's just that you're on the positive edge versus the negative edge. But people would see it more professional back then. They understood, where now it's almost, how can I gamble and how can I gamify that? And I think that's a terrible attitude that will eventually fall. In 6 months, I've seen, just by looking on Twitter, how it's gone from prop firms you would try to get capital, scale up. Now you can buy yourself into being a 7-figure trader.
True, without evaluation, yes.
Which is a false sense of identity, because if you call yourself a 7-figure trader, by definition of just buying your way in, it's fake. What I do see in the industry, which is laughable to me, is I want to trade 100% mechanical and then I won't have any psychological issues. If that was the case, you've got ICT. And if it was that easy, you take any intelligent person that's competent to learn and go, right, when this happens, do this. Fine, do it. Why do you lose your account after 60 days then? If you remember the early SMC days when it was the 40% in the morning before you've made your scrambled eggs, it was this facade. But then FTMO would come out and say, hey, our top traders are making 3% per month. So where are the 40% before they've had their breakfast? And what it done is that it made 10% a month seem like it was average when it's not.
What would you say for a trader of what is realistic in terms of what is a realistic win rate? What is a realistic risk to reward? What is a realistic gain, trade frequency? What is normal and in a professional approach that you've seen?
Realistically.
Ladies and gentlemen, welcome back to another episode. I'm joined by Mark Hutchinson. So he's been around in the industry for longer than anyone I can really. I've been following you, Mark, for probably since I started in my own trading journey. I saw you're a prominent figure, especially because you're from the UK, and now that I realize around the corner from where my family is. It's a pleasure to have you on, and thank you for giving the opportunity to a smaller channel. I've seen right now you've been in Dubai doing a mastermind. So how has that been?
It's been exceptional. It's been a couple of days, so only a very short trip, and thank you so much for having me on. The podcasts that I've seen so far have been phenomenal.
Thank you.
And your interview skills are exceptional.
I'm sure we'll have a good conversation. Thank you, bro. So I want to give give you an opportunity to have a brief introduction of yourself. You mentioned you've been trading for 15 years. So since your late teens, you've been involved in the trading space, and then a prominent figure more on social media for 7-8 years or so.
Yes.
So talk to me just very briefly about your beginning days, and then we'll jump into some deep topics.
For sure. I'll keep it very short and brief, but essentially I got chucked in the deep end. Very different type of industry back then. I was an engineer, studying to be an engineer, kind of going down the typical route. Very much family precious to do that as well. Brother's an architect, that kind of certificate-based route. Got made redundant. Had a few bits of savings, saw a seminar in London, decided to go on a 2-day kind of experience, 2-day course, started learning how to trade stocks, and then I started from there. So after a period of time, built up some capital, lost all of it, broker went under liquidation. Then I just thought, right, can I apply the same principles that I'm learning in the stock market to the Forex market? Because there was Forex courses at the time as well. Yes. So I thought it must be different. I'm very new to this industry. I remember earlier days thinking I want to be a stockbroker. You don't really understand what that actually means. So I really just stuck at it for long enough to figure out my mistakes, simplify the way that I trade. And as I got more and more experience, my charts just got cleaner and cleaner, and I found an edge. But the origin of how I trade still started with stocks. I've just developed it and then simplified it.
Why did you decide to pivot from stocks to trading Forex?
I think it was the bad experience. It was more trauma related than logical at the time. When you build up an account, it was only 10K, it wasn't huge, but at that time, that was a lot of money for me. And I remember it was MF Global. I'm not sure if you remember them, but at the time, huge company on the New York Stock Exchange. And I got a call from my brother. He said, can you log into the account? I was like, what's happened? And then I realized I couldn't get in, and then it was just finished from there. So it leaves a bit of a bad taste in your mouth, and you think, right, I'm at risk here. These are things that I don't understand. What if that was 100K? Because really and truly, I built that account incorrectly anyway. So it was almost like the market doesn't let you get away with anything. And if it was that experience, it'd be something else
over a long
later
term,
down the line.
Yeah, you can't. There's no accidental profit in the market. So you mentioned off camera just now, you feel it was an advantage to start at the time that you did, because everything has changed now. And I want to touch on that because it's an interesting comment or reflection to have, where myself, for example, I got into the industry because of what I was seeing online. And I think everybody more or less gets into the industry through what they see on Instagram and social media, because trading is not one of those things that anyone has a burning passion for from the outside. When you get into it, that's a different case. But from the outside, it's not the most glamorous or interesting. It's very niche. But I think people get into it for what they see and maybe align with their goals of financial freedom and so forth. Away from social media and the situation you were in when you were first starting, what is it that called you to trading in general?
Again, it was being in that situation that when I was made redundant, I realized very, very quickly, there is no security here. So you're conditioned to think, get a job, it's safe. Anything else is a risk. And I thought that, I was sucked into that. As soon as I was made redundant and I saw these top engineers, principal engineers, like really on high pay at this point, like 80, 100, 120K, they're on like 6-figure salaries. They're walking out with a box in their hand and they look lost. I thought, I never want to be in that position ever again. So I don't want to then now apply for an architectural practice where I could get away with, you know, becoming a junior, work my way up. I don't want to do that. I need to find something that is going to give me freedom. Not so much money, freedom. And I think that's where my advantage that you touched on came in, because I wasn't actually looking to get into trading to make money. I knew money was available, but at my limited consciousness at that point, I was thinking, if I can just make $3,000 a month, I'm sweet. That would
low
take care of that.
expectation helped, probably, yes.
Versus what you see on social media, it's 30K withdrawal from FTMO, 20K here.
That's a Lambo in the first year.
Yes. Yeah.
So because you were in a more of a unique circumstance when you were first starting off, and then you see new participants coming into the market all the time, what kind of a difference in attitude and framework do you see between people from your time when they were first starting out and the newer traders coming into the industry?
Very simple. You knew when you got into trading that there's an element of gambling to it. It's just that you're on the positive edge versus the negative edge, right? When you've got a system and you understand what you're doing. Yep. But people would see it more professional back then. They understood, where now it's almost, how can I gamble and how can I gamify that? So the attitude is completely shifted, where before it would almost be taboo because you wouldn't want to bracket yourself as, no, I'm not a gambler, I'm a trader. And I understand that. And I would feel exactly the same way. Because when you've put years in and someone says, oh, so you trade, so you're a gambler. You would think, no, I'm not a gambler, because there's a lot of risk assessment that goes into this. It's almost a bit of an insult, where what I see now is people are very comfortable and will glorify the gambling. How can I gamify a prop firm? Yep. And I think that's a terrible attitude that will eventually fall.
What do you think is the major defining traits or approaches between somebody that is more in the gambler's area, and there's ways that gamblers are making it work, maybe not on a 10-year horizon, but to gamify the prop firms, there's ways people are doing it, but it's instilling certain habits or ways of approaching the market, which is in a gambler's box. I want you to talk me through what is gambler's box versus what you would consider more of a long-term sustainable or professional approach.
That's a good question. I would say, and what you refer to is that I don't want to confuse the small percentage of people that can do it, because I know some of them that can do it and can do it very well. However, I often refer to it as that these exceptions do not define the rule. Yeah. And as a person of influence, I think more of these individuals should take more responsibility to understand that you're a niche, you're a 1% individual that has the personality to do that. You know, there's only a very small percentage of people that can even play with numbers. Some people can decide, right, I'm going to risk 3% on this trade, but then I'll risk 1% on that. To me, mathematically, that makes no sense whatsoever. But I also have the awareness that if I wanted to do that, I could do that, but that's only through experience. So you imagine a beginner and learning from these people, going on Twitter and following individuals, they're listening to them thinking, I can do that. Yeah. They can't. Trading's difficult enough as it is. And then you want to play with the numbers, because at that point you're saying, you know every single outcome of the trade. Because we bring probabilities in and understand that and accept one bracket and say, right, you don't know the outcome of the trade, but you'll take the setup over and over again. Yet now you're quantifying the value of the setup, saying, well, this is an A+, so I'll decide to risk 3% on that. But you know it's not absolute. So someone who's been in a game will understand intuitively how to do that. A beginner cannot. They're trying to get consistent as it is. Then they're playing with risk. So you imagine they take that trade that they class as a setup and they think, I'll do 3% on that. They take 2 of those that were actually really good trades. They just happen to be 2 losers, but they're down 6%. Their mindset's all over the place. So I would say that's one element of it. The other side of it that puts them in the gambling bracket is really just who they follow, who they're influenced by, because they're seeing too much of the gamification. I think it's more not process-based, it's more circle-based. So it's where their attention is. And in 6 months, I've seen, just by looking on Twitter, how it's gone from prop firms, you would try to get capital, scale up. Now you can buy yourself into being a 7-figure trader.
True, without evaluation, yes.
Which is it's a false sense of identity, because if you call yourself a 7-figure trader, by definition of just buying your way in. It's almost, it's fake. And then you identify as one. And then when you lose that capital really quickly, I actually had a trader not that long ago, 1.6 million in capital. It's gone. Yeah. How can you be a 7-figure trader and then next week not, just from drawdown? You know, and I think that part of gamifying it too much, not focusing on the actual process things that professional people would do, and not really treating this like a long-term business. I would say that's the biggest thing.
You mentioned the idea of A+ setups and managing risk accordingly to your models and setups. And it's an interesting point because I've had debates on this topic exactly. And on a roundtable that I did on Riz's show, it was a long discussion that me and Umar Ashraf had. And I was on the side of the fence of, I have models and I know the data of my models. But I've just been in the frame of I'm always going to just keep risk management set. And there's variables we can play with those. There's plates you can spin. And I prefer to play with the risk reward or profit management or win rate, which is choosing the models. But I didn't like to spin the plates of risk management. I like to keep that fixed. Are you therefore more on the side of risk management as something that should be standardized across, or would you double down on a setup, or maybe not on a specific setup, but maybe in a certain situation when you're more in profit or you're on a win streak, or is there any adjustments you'll make to your risk?
Yes, so you touched on the word situation. I think it's situational. So standardized in the sense of you getting to a certain level. So let's talk from a prop perspective, because I believe it's the most relevant as to what people have access to. You can risk a certain amount. I'm not talking about the 4% to fluke an assessment. Like, let's say you do it properly, you've got the capital, you're now in profit. You can set a rule. A lot of our traders do this, where when they're up over 2% in profit, they can then risk 1%. They risk 0.5% all the way up to that. But then you also need a recovery metric that if you go back down, you're then lowering the risk. So just from a common sense point of view, you want to keep yourself in the game. And I'll explain why it's important. And it's less about risk and more about your association of prop firms. So let's say, for example, you're someone who's done quite a lot of assessments. If you remember years ago, and I'm talking about the earlier stages, a common thing would be, I've blown 20 accounts, and they almost wear it like a badge of honor, thinking there's no detriment from a mindset point of view. You will associate yourself with that and you'll get comfortable with it. And the reason why you will is because if you've blown 18 accounts, you're almost immune to it. Now, I know this idea of, get knocked down 7, stand up 8. That applies that applies to certain things, not this, because I don't think there's a net benefit to doing that. Because let's say, for example, you take a trade you're not particularly happy with, and you've blown 18 accounts at this point. You're very comfortable losing accounts. You get very good at it. So you're going to go on tilt very quickly and then sabotage faster, lose the account almost from a sense of relief. But I can start again. But now you're so comfortable doing it, you do it again and again. And that's why you see people have got 36 accounts. It's insane to me. Yep. But before it was the blown account. So like you would blow your personal capital. Now you're comfortable. It's just past different
there's less repercussion. Yeah. You know, they say, and I see what you're trying to say of there's elements to life or just approaching success in general versus approaching success in the market. And they don't always communicate. For example, if I'm someone that wants to possess the trait of patience or resilience, I'd probably want to go through hardship to develop the traits of patience. If I have a comfortable life, I'm not going to be a patient or resilient person. So it's kind of like you have to experience the opposite to achieve the trait. But you're now more saying that to achieve certain traits in trading, going through hardships or going through blown accounts actually instills more trauma. So talk to me about that, because I feel like this is a topic you have extensive knowledge on, especially because I've seen your series Rewired. More on what is major traumas or major things holding people back in their mind, specifically in the trading space when they begin and as they develop as a trader.
Number one, their association of what trading is. So that plays a huge role psychologically. Whether they're conscious to it or not, it's happening. So for example, I'm curious to you, when you hear the term Forex trader, what comes to your mind? Is there any like images that come to your mind straight away of like how you visualize that?
Yeah, when I look at the industry as a whole, I see somebody that's chasing a dream, chasing a lifestyle, and it's very, very money orientated, but I think more so it presses on the emotions of insecurities of men. So what is a young 18-year-old guy insecure of? It boils down to a few very simple things. One is like their status and their presence. One is maybe even women. And when you start to see that Forex in their mind will help them achieve the things that they are feeling like they are lacking, where money can solve this problem, money can give me status, money can help me buy a car, money can help me have access. All of these things is more like you're trying to embody what it means to be a man, but as a shortcut through the industry, as opposed to going through the hardships that it takes to possess those things.
Yeah, I completely agree. And because of that image right there, every single action will now be dictated through what that means. So let's say we add a few other images in there, like to be a Forex trader, that's someone that will probably take trades. They're quite active. They take trades a lot. So you're more inclined to only feel like a Forex trader when you're trading. But we know a position is not being in the market as well as being in the market. But if your imagery is, no, Forex traders, they trade, they're in the sessions, it's quick, it's active, it's fast, you're going to be inclined to have an itch to want to be in the market, force trades, revenge trades. You're going to be looking for stuff that it's not even there. And the only way that you feel alive is when you're in the markets. And that's why these people, and you can see it in the data. So this is not even my opinion at this point. All you've got to look at is the numbers and look at the emotional decisions that people make. And you'll see there's actually so many competent traders that could be great, yet they cannot control their impulsivity to just find a position. And then they get comfortable making the mistake to then just do it again and again. And they almost know they're going to do it. They do it to then mess up, to then reset again. And it's this vicious loop. It's the reason why that people get the biggest payouts on prop firms. They'll lose it 60 days later.
Yep, that's the stats.
They can't all have a technical problem.
That's true. So I'm seeing that you're cautious, or you want to put a disclaimer out to specifically prop firm traders, because they can habituate to losing an account. Whereas if you deposited your real money, you would feel that, and it's not something you can really acclimatize to, losing your real money. But blowing another challenge, it does build an idea of whatever, and let me go again, especially when people see the gamification elements of, do the risk reward of the challenge fees. I might put $10,000 into challenge fees, but if I can get 100,000 in payouts, I've got a 1 to 10 risk reward in the gamification of the model, but that doesn't always instill correct approaches. Do you feel like there's other similar detriments that a prop firm trader will have over a traditional broker, real capital trader, as opposed to a prop firm trader? Because one thing I have seen, for example, the leaderboards on prop firms, that doesn't need to be there. And I did question, why is it even there? And yes, it's a marketing gimmick for the prop firms to speak about, but reading between the lines, that is more that thing I said of men are chasing status, and this is a male-dominated industry, and they are seeking approval externally, and whether that's through materialistic or maybe now even they're doing a route in life that they maybe aren't the most supported in. You left engineering, I left dentistry, and a lot of guys maybe are just trying to prove it to their parents that this is going to work. And the moment you have a leaderboard and a certificate, that is more like you haven't really achieved too much yet. You're not full-time, you haven't even taken a payout, but you've got a certificate to show people that I have achieved something, or the accolade of 7 figures in funding. Is there other pitfalls or psychological burdens you're seeing specifically in prop firm traders?
The leaderboard that you touched on is a huge one, because that's become the biggest flex, where people on the tip of their tongue, it's like, but who's on the leaderboards? Yep. So that becomes, as you said, status, and I think that's what they're chasing. But they're chasing the wrong thing. The same way the goal is to be rich, not look rich, right? That's something within itself, where people will go out of their way to try to look rich versus be rich, and they would prioritize at their own detriment. So when we understand the psychology of men, because of the status part, they will do things that are not within their favor just to appear more successful. And even if it's buying loads of accounts, going high risk on a few trades, and it happens to work out, and you see your name on that leaderboard, that is enough validation for you to go, I'm the fucking man. But the reality is, you've got loads of debt, you're all over the place, you've got no assets, you don't have a plan, you've got no goals, and you actually haven't structured your life. But to the Twitter world, you're the GOAT.
Well, is the dichotomy or the false belief that someone on a leaderboard and therefore the abnormal gains are the ones that we should strive to achieve, which is not realistic on a long-term horizon, because as you said, the stats show that they don't have that account in a few weeks later. I want to touch upon the idea of, I think a lot of people arrive after a year or less than a year where they start to understand what are the emotions of a trader, or what are the negative repercussions of these emotions. For example, they'll know by now, I will face greed, I'll face fear of missing out, I will revenge trade. And these are things that is very easy to arrive to. But the challenge becomes once you're aware of it, once you even know what they are, even if you've recognized, I do this, I'm on a losing streak, but I'll still take trades and keep losing. I think a lot of traders arrive at that point and they don't know how to address it, apart from what they hear on the internet, which is, let me meditate, let me journal, and let me go to the gym to release. And that is all maybe scapegoat kind of mechanisms of, I'm feeling an emotion, I don't know how to deal with it, process it, I don't know where it's coming from, let me go to the gym to almost suppress it. When you see people, or in your own journey, you face certain emotions, how did you deal with them, especially the most common ones like greed and fear?
So I approached it from a very practical, more of a neuroscience point of view, because as you said, all those other things, they're just escape mechanisms. They don't deal with the root. Yep. So the average human has roughly like 60 or 70,000 thoughts every day, right? 90% chance it'll be the same the next day. So if you don't change the way you think, you just repeat the loop. Right, you just repeat the same thing because you think the same.
You're in a paradigm, yeah.
So you literally have to reshape, rewire. That's why we created it. Rewire the way that you think. And the only way to do that is to follow a specific formula. You can't think that more market experience is just going to deal with greed better. I would agree that over a period of time, yes, you become a little bit more numb to it. But if you've got incorrect form, you're just going to get injured with more weight. And people are not understanding the detriment. Like, you will go unpunished for a long time. If you're squatting 10 kilos, you'll squat 10 kilos for years and no issues. The moment you put 100 kilos on your back and you don't know what you're doing, your back's gone in just one decision, right? So I see it the same way. So I've approached it from, right, how can I interrupt those negative thought patterns? How can I bring awareness to, why do I even respond the way that I do? Why, when I'm driving the car, that if someone doesn't wave me through, that ruins my day and I've got anger? We're not understanding that everything is connected to everything else. So how you are outside of life is exactly how you're going to be in trading. And we don't want to address that. We think, right, what I do see in the industry, which is laughable to me, is I will trade 100K because my psychology doesn't get affected at 100K, so I'll just stick there. Or I don't want to deal with my psychology. Or I want to trade 100% mechanical, and then I won't have any psychological issues. So that doesn't make sense, because the data would show, if that was the case, you've got ICT. That's more mechanical. I mean, I don't know the ins and outs of ICT, right? I have a rough understanding of the trading method. However, if we're going to go with, well, it's mechanical, then surely the numbers would reflect that people wouldn't be making emotional decisions. Because that's the questions I get. Right, Mark, I trade this. You seem a bit too discretionary. So I want something that is 100% mechanical. So, okay, fine. So you're essentially playing poker with your cards face up. Because it can be reverse engineered. And if it was that easy, you take any intelligent person that's competent to learn and go, right, when this happens, do this. Fine, do it. Why do you lose your account after 60 days then? The data doesn't support that. The same way when, if you remember the early SMC days, when it was the 40% in the morning before you've made your scrambled eggs, you know, but it was this facade. But then FTMO would come out and say, hey, our top traders are making 3% per month. So where are the 40%, you know, before they've had their breakfast? And they would laugh at and what it done is that it made 10% a month seem like it was average when it's not. And then they started, and that was the problem. But the same individuals that created the problem have now changed their mind. So the same people that was pushing that narrative are now focusing on, don't worry about big returns, focus on small returns. So it's interesting. What I notice is that, and I don't think it's malicious, I think it's that they've realized as they've scaled up, maybe they did catch a few of those trades, go from 100K FTMO to 400. And they've sat there and thought, I can't put a 2-pip stop on this because I actually want to take this seriously now. So why is it when the capital increases, so does the stop?
Behavior, You know, it's also maybe a case of the pendulum swings and it goes from extreme to extreme in the industry. And because you've been around long enough, you've seen those full swings. And that could be from a perspective of marketing too, where at the time people were struggling with X. So the pendulum swings in the opposite to bring those people in. When people are at that side of the spectrum, they're like, okay, well, it's not as green as I thought it was. Let me swing back the other way. So when the pendulum does swing back and forth, there is a point in the middle, which is things that are more or less evergreen or more sustainable models that are not on the periphery, that are more marketing sentiments. What would you say are those things in the middle that are more tried and tested or reliable, down to what is a realistic win rate, what is a realistic risk reward, what is a approach to the market that you would say as a new trader, this is the best place to put my attention and efforts into?
I would say you have to follow money flow. So number one, from a strategic point of view, you need to know where the liquidity is. You need to know where the most of the volume is, where the bigger players are getting in. I'm always in agreements of that, because some people have a misunderstanding as to how we trade, when there's probably a lot of similarities when it comes to things like SMC, ICT. You may just call things different names, but fundamentally we're in agreements that we want to be on the right side of the money. What I think traders need to have in place is good risk model, right? And you can play with the risk when it comes to prop firm capital, but do it from a position of profit. Have a recovery plan. Like, have things in place that if you go below break even, don't just become the trader that just goes, right, I'm blown it now, and give yourself permission to just become more reckless and then lose the account and just repeat the loop. So like, have something in place. And it can be, look, when I go to break even, I go 0.25% and I build back up. But the problem is that if you're fundamentally put in a timeline of when you think that you should make it because you've told your friend that you're going to be a 7-figure trader at the end of the year, you're going to force that timeline. So firstly, just get clear on what that is and actually write it down. Don't just say it, because you can't work from just your mind. You'll forget. You have to work from documents. So I believe, think about it, if you was creating a business plan, you would write this out. You'd be like, what is my risk profile? And you'd write it all down and say, I've got to stick to this. I've got to be disciplined, because if I can't keep to my word, what can I keep to? So you do that, number one. From a profit target point of view, there is an element of, if you're risking 2-to-1s, 3-to-1s, which I know people have done it successfully, but exceptions don't define the rule. And I've not seen many people at like a mass scale pull that off and then get into drawdown and then get out of it, because they end up blowing it. Because what happens is that they intuitively know that I should limit my risk a little bit, because I was in profit, I'm risking, let's say, 1% per trade. They just happen to take, and they might be good traders, they just happen to take a sequence of 8 losses. They're now in drawdown. And they're thinking, right, I'm taking 2-to-1s and 3-to-1s, but I'm risking 0.25%. How long is that? It's a very tedious, boring process. And then they end up just thinking, this is too boring. Let me just do something high risk, ruin the account and reset. And then the loop starts again and again and again. So I think there are some adjustments that can be made when it comes to understanding the higher time frame narrative and just holding some of those trades a little bit longer to allow and compensate for that drawdown period, which inevitably will come for any strategy. I would see traders that would show me they don't really understand what the higher time frame is. And I'm thinking, you're pretty switched on when it comes to all the intradays, but you're not looking at the 4-hour and seeing a simple 4-hour structural low that you could just manage that trade a little bit better. Like EU is a great example. I don't specialize in one currency pair, but I can trade euro dollar very, very well. And then recently we've had a lot of traders that trade those type of strategies come over to Rewired, right? Because they've understood I kind of need that psychological training. And then they would just ask me questions, what do you think of this? And I've never been the type of trader to say, like, look, you trade SMC, so you can't be in Rewired, and then we're going to, strategically try to convince you to come to Falcon. It's really not that angle, because we actually want those traders to trade on our fund. So we're allowing a certain amount of people to trade on our in-house fund to hedge that risk, whether it be a more aggressive or more conservative style. So we don't advocate for trying to, get you into Falcon. Like, you trade well, great. We want to make some adjustments. But what was interesting about it is I looked at a lot of euro dollar trades, because I understand euro dollar or pound dollar is going to be the most dominant one. And I would zoom out and see so many of these trades where we've actually entered at a very similar point, yet managed differently. You would have just added another 4 or 5%. But there wasn't much risk to it, because you had the money flow, 4-hour, right? You had momentum on your side, and you're almost cutting the trade out of, you've got this mechanical approach of 2-to-1s, 3-to-1s. And I understand that will work until it doesn't. But I only think a small percentage of people that can pull it off, and you maybe know some of them as well, and they do it very well, and that's fine. But for the majority, they struggle with it. And I've seen the same conversation, worded differently. I'm deep in drawdown, and now I'm risking 0.25% or 0.5% to get out, but I'm only focusing on 2-to-1s and 3-to-1s. And I've been in this for like 6-7 months.
This topic is very interesting to me, of risk management. So you've kind of alluded to the fact that you'll have a certain risk when you're trading normally, but when you enter a drawdown period, or maybe you're on tilt, you should pull back on your risk. And then you've also identified the equivalent problem that arises, which is Therefore, you're stuck in drawdown for so long because to climb back is taking longer. And therefore, the emotions that come alongside with that newfound problem, which for me, I've always kept everything standardized. I don't want to, on a winning streak, increase my risk or double down, or on winning models, put more risk on or put more size on. There is the argument that Umar was also mentioning to me that, well, how do you plan to scale or, really go aggressive, or not aggressive, but more compound your account, whereas mine might be more linear. He'll take a more build a buffer and then go exponential by the end of the year and then start again and refresh the year, whereas I try to keep a more linear approach. For that, I don't think there's a right or wrong, but it's for a specific kind of trader,
personality
specific person.
difference.
So for me, I've kept it standardized because I've seen that if I'm on a winning streak, or if I have a belief in this model, or even if I have data that this kind of trade model is a more winning one, and then I increase my size on that, and it just happens to be this is the losing situations. Let's say I have 80% win rates on this model, but I'm going through that 20% losing period. Our wins and losses are randomly distributed, so I can't say the wins will come first. It's mixed within. Maybe I'll get a series of losses back to back. So if I've increased my size and I'm just happening to go through more losses, and then I've reduced my size on the trades that are going through more of a winning period, I've now thrown off my portfolio just through adjusting my risk and the emotions that might come with that. And then also through a losing period, if I reduce my risk, it's a bigger mountain to climb. Why do you believe it's important to modify your risk, especially when you're in a losing or drawdown period in your account?
The number one reason for that is to keep yourself. So my point of view is that I don't want traders repeating the loop of just losing and getting comfortable with it, right? Because if you do that, what the risk profile does is it allows them to stay in the game. And sometimes them staying in a game is more important than the actual numbers that you're talking about. Standardize it as much as possible. I mean, me personally, I'm not playing with risk that much because I'm sticking at 1% all the way through. But if I was on a prop firm, then I would 100% be incrementally scaling up, but I wouldn't go more than 1%. I wouldn't then get to 5% and go, right now I can risk 2 and play with those. I would just at least have a recovery plan. But it's not to actually keep the account per se. It's more so to just don't get comfortable blowing loads of accounts. And sometimes what you'll learn in that period of controlling the risk, it allows the trader to emotionally embrace the fact that, look, you're in drawdown, don't be reckless now. Can you keep your discipline? So it's less about what the numbers do and more about the traits they develop in that period. And we have that a lot. We don't have reckless traders. And that's what I would rather prioritize that, because I believe they have a greater chance to eventually succeed.